Between October 2025 and the summer of 2026, more than $2 trillion evaporated from the crypto market. Bitcoin fell about 54%, from an all-time high near $126,000 to below $58,000. The total value of all crypto was cut by more than half. And here's what makes this crash different from every one before it. There was no villain. No exchange stole the money. No stablecoin collapsed overnight. No founder lied to Congress, no fraud, no perp walk, no name to put on a thumbnail. For the first time, one of the biggest crashes in crypto history had no bad guy in it at all. Which raises a much more unsettling question: if nobody did anything wrong, then what actually broke? This is the story of the crash with no villain, and the quiet way the so-called smart money left everyone else holding the bag. To feel how strange 2026 was, you have to remember how good things looked at the top. In October 2025, Bitcoin hit an all-time high of about $126,000. The entire crypto market was worth roughly $4.3 trillion, more than it had ever been. And crucially, this time the mood was different. Crypto, everyone agreed, had finally grown up. The reason was a single product. In January 2024, after years of rejections, US regulators finally allowed the spot Bitcoin ETF, an ordinary fund, traded on a normal stock exchange, that holds Bitcoin for you. Suddenly pension funds, financial advisors, and cautious retail investors could get Bitcoin exposure without ever touching a crypto wallet. The biggest of them, run by BlackRock, the largest asset manager on Earth, pulled in tens of billions. This was supposed to be the turning point. The pitch was everywhere: the ETFs would bring in sticky, patient, institutional money, the grown-ups, and that steady hand would finally calm crypto's wild swings down. The adults were in the room now. What could go wrong? What went wrong is that nothing exciting went wrong. And that's the whole point. Through the first half of 2026, the weather simply turned. A US Federal Reserve that markets had expected to keep cutting interest rates instead signaled it was in no hurry, and when safe returns look attractive, the riskiest assets on the menu are the first to be sold. Crypto is the riskiest thing on the menu. There was no hack and no fraud. Just a slow, grinding risk-off tide going out. But the real tell was in that sticky institutional money. Because when the tide turned, the ETFs didn't hold the line. They ran. In June 2026 alone, investors pulled a record $4.5 billion out of the spot Bitcoin ETFs, the worst month since they launched. And here's the part that stings: roughly 3/4 of that, about $3.5 billion, came out of BlackRock's fund, the single biggest one, the supposed flagship of the adults. Across the first half of the year, those ETFs saw their first net outflows ever. The money that was sold to us as the anchor turned out to be the fastest to the exit. It was Bitcoin's steepest month in years, and it happened not because someone stole anything, but because a spreadsheet somewhere clicked sell. Now compare that to the last great crypto crash, in 2022, because the contrast is the lesson. In 2022, Bitcoin fell even harder, nearly 80%. But that crash had a cast of characters. There was Terra, the stablecoin that was supposed to be worth $1 and went to zero. There was Celsius, the lender that froze everyone's money. And there was FTX, the exchange whose founder is now serving 25 years. 2022 was a crash you could explain with names and crimes. You could point at someone and say, that person did this. 2026 gives you no one to point at. And strangely, that's scarier. A crash caused by fraud can feel like an exception: round up the criminals, tighten the rules, and tell yourself the thing itself is sound. But a crash caused by nothing in particular, just interest rates and mood and money changing its mind, tells you something more uncomfortable: that the falling was never really about the villains. It was about the asset. Strip away every fraud, and it still drops by half when the wind changes. So what actually broke in 2026? Not a company. A story. The story was that institutions would make crypto stable, that once the serious money arrived through neat, regulated funds, the gut-wrenching swings would fade. 2026 was the first real test of that story, and it failed in the plainest way possible. The institutions didn't dampen the fall. Through those ETFs, they were the fall, able to sell billions with a click, faster and calmer than any panicked crowd ever could. None of this is a prediction about where the price goes next. By the time you watch this, it will have moved again, up or down. It's just the durable lesson underneath the noise. Every market eventually asks the same rude question FTX asked, that WeWork asked, when the story meets the exit, who actually leaves first? In 2026, crypto finally got its answer. The adults were already gone. If you found that useful, the whole channel is about the same thing, following the money past the story to see how it really moves. Subscribe, and I'll see you in the next one.